stocks, treasury bonds, treasury bills, and commercial paper. What are they? What do they mean? How does someone invest in them? So this, you probably heard about these terms everywhere anytime you've heard about investing, but what do they really mean? So in this video I'll break down each of them in simpler terms for you to understand, and I'll show you how they differ and show you how to invest in them, so that by the end of this video, 10 minutes, you will have known what they mean and uh, how does someone start investing in them. So let's start with a stock. What is a stock? A stock is also known as a share or an equity. And from the word share, it implies that it's a unit of ownership in a company. So the company sells some shares, then you as an individual, you purchase those shares. So you own a part of that share. So when you buy a stock, you become a partial owner of that particular company. Let's look at the rights and rewards. Now, you may get dividends, also known as a share of profits, and capital appreciation if the company grows. If the company grows and you had bought a portion of that company, it means that the portion that you own also grows in value. But it has got a risk. That's the same way that share can rise in price, it can as well perform poorly and the share price will drop, sometimes even go to zero. So it's a risk. Anything that has got a reward has got a risk. Look at this example. There are 100 people who own a restaurant. If you buy one share of that restaurant, you own 1% of that restaurant. If the restaurant gets famous, your 1% grows in value, becomes valuable, and similarly, if it fails, your share also loses value. So if you have shares in Safaricom, Equity Bank, KCB Group via the Nairobi Securities Exchange, if the share rises, if the value of the company rises, then the price of the share also rises, and you, the owner, gets a profit, gets a dividend, or you get a payment. Let's look at a bond. What is a bond on the other hand? A bond is a loan that you give to a company or a government. In return, the company or the government promise to pay you a periodic interest known as a coupon, and at the same time return the principal at maturity. People use bonds because bonds are stable, and they are stable compared to stocks because these ones are instruments that are offered by the government. Their risks are minimum. So their risks are always minimum. An example, you lend 100,000 shillings to a business at 10% per year or per annum for 5 years. They pay you 10,000 every year, and at year 5, the last year, they return the 100,000 that you gave them. That is a bond. Let's look at, in Kenya, the examples are the Kenya infrastructure bonds, corporate bonds issued by companies. For example, big like banks and big corporations will always issue their bonds for people to purchase. Let's look at treasury bills. They're closely related to bonds, only that they are short term. So treasury bills or T-bills are short-term government debt securities, and they have got maturities of 3 periods: 91 days, 182 days, or 364/5 days. How do they work? Mechanism. They often sell at a discount and pay face value at maturity. The difference is your interest. This is an example. A treasury bill, like I want to use an example, is a short term IOU from the government. So you pay, for example, you pay 95,000 Kenyan shillings today for a bill that matures after 6 months and its value is 100,000 after those 6 months. This interest between 95,000 and 100,000 is your interest and is the discount. So they are normally low risk. So a recap, I've said they sell at a discount and pay the face value at maturity. So the difference becomes your interest or the amount of money that you earn. It's low risk and it's great for short-term investment or cash packing. You have some amount of money and you want it to be there for a certain period of time, 3 months, 6 months, or 1 year, you pack it there. The last example, commercial paper. What is a commercial paper? A commercial paper is a short-term unsecured debt instrument issued by corporations. The purpose of doing so is to raise capital. It normally matures between 30 days and 270 days. Just the same way, like I owe you from the government, this is I owe you from a particular company. So instead of government or the bank. Does it have any risk? Higher risk than the government, but generally offers slightly higher returns as compared to the government. Look at this example. A farm or a factory needs to raise cash for payroll for 6 months or 8 months. So it issues out a commercial paper and promise to pay that money plus interest after a certain period of time. So investors, you and me, will buy that paper for a fixed period, 6 months, 7 months, 8 months. And then the company will pay us uh, the money plus the interest that we agreed on, the interest that it proposed to pay back. Those are the four categories that we are looking at. Now, comparison and differences. Where is a particular investment vehicle suited? Stock is for long term, it has got high risk and high liquidity. Bonds are for medium to long term, moderate risk, and the liquidity depends on the market. Treasury bills, short term, very low risk, very high liquid. Liquidity is high. Then commercial paper are for short term, moderate to high risk, but the liquidity is also moderate. Who issues them? Stocks are issued by companies. Bonds are issued by governments or other corporations. Treasury bills are issued by the government. Commercial paper are issued by corporations. So those are the differences between them. Who should use what? Who should use what? For beginners or conservative investors, those who are conservative with the investments, start with the treasury bills, high quality bonds, or bond funds. For moderate risk appetite, moderate, not too low, not too high, add some stocks and do this in blue chips companies. These are companies that have been proven to offer constant payouts. Think of Safaricom, think of Equity Bank, think of Cooperative Bank. And diversify your funds. Perhaps put some in commercial paper if accessible. If for growth or long-term investors, higher stock allocation, but keep bonds and treasury bills for stability. For institutions, corporate organizations, or high net worth, they could access commercial paper, corporate bonds, because of the fixed income allocation. As you conclude, you know what stocks mean, Treasury bills mean, bonds mean, and commercial paper, what they are and what they mean. So not just in theory, but in practical. These four are the practical building blocks and foundations of any smart investment portfolio. We've done a video on how to build an investment portfolio. I'll link it either up here or in the description. And that is it for this video. Thank you for watching, and I'll see you in the next video on investment. And until then, stay safe and bye-bye for now.